Welcome back, guys. If you're somebody who finds yourself on the opposite side of a chart or not being able to take part when you can just see price running off without you, you don't know where you should have been getting into the market, where you could have put your stop loss or where you're going to be putting your profits, stick around because I'm going to be showing you the 4 ways which I know how to trade breakouts and the 4 separate places where I know to put stop losses. And I'm also going to show you how to document it so you can go through and back test for yourself and see which one of these strategies works best for you so you can get involved in those month makers when they do happen. Right guys, so looking at the charts on the screen, what you'll be able to see is my little made up version of a support resistance line and basically what price is doing. So just to run things through really quickly, you've got price coming up, touches this what wouldn't be at that moment in time a support resistance line, but it reaches up to here, comes up again, works its way down, back up, touches it for a 3rd time, which for me would confirm it as a support resistance line or simply as a resistance line, which would be the area for the breakout zone. So when you've got a series of touches, so let me show you on the chart actually. So when you've got a series of bounces off a particular line like this, that enables me to say, right, okay, so this is going to be an area where I'm going to be looking to be getting into the market as part of a breakout strategy. Now, with the breakout strategy, there are 4 different ways which I know that you can do the breakout. There's probably more. If you know of more, by the way, just put it into the comments section and let me know. And I'll probably go back and back test it and create a video based just on that. There's 4 different types of breakout trades. There's the pending order on the line, which would be this line. There's the market entry on the close of the break and break above, I should probably have in there. The pullback to the support resistance level, which is the pull back to the line, and then there's a pullback to the nearest, which I do anyway, to the nearest opposite candle. So to simplify that, there's actually 4 places where you can look to get in. So there's on a pending order on the break of the line, which is right there. Then there's the very next candle. So just as price closes, so similar to this one, you would look to get in exactly there. So as price closes, you get in with a market entry order. And then there's the pull back to the line, which would be back here, so same as the first place. And then also looking at this wick right here, which is the red candle, trying to get in there. So there's 4 possible places where I look at when looking at breakouts. But first of all, a breakout or a support resistance line needs to be established. And again, as I've just mentioned, that is usually where you get a series of touches. So we've got 1 touch here, 2, a 2nd touch, a 3rd touch, and then we've got the breakout. Okay, so I'm just going to go through these scenarios and I'm also going to demonstrate on a spreadsheet how I would go back and back test all of these different scenarios. So you might be looking at a different currency pair, so you might be looking at the euro dollar, you could be looking at pound Swiss franc, and so on and so forth. You could be looking at all sorts. And then you could be looking at different time frames as well. So this is the 1 hour chart, you could be looking at the daily, you could be looking at the minute chart, and so on and so forth. But you want to make sure that you're documenting everything in a spreadsheet so you know which type of breakout it is that you feel most comfortable with trading. It's not necessarily always the best on paper, it's actually what you feel more comfortable trading. So there's one which you'll see in a minute where the probability of it playing out is quite low, but the risk reward ratio is enormously high. And then not only are we going to go over where you'll get into the market, but also the different stop losses which I believe that you should be considering when trading the breakouts. Okay, so just to run through those in order, in a real quick order, the first one is the base of the body of the last candle before the break. So in that instance, we are looking at right here. And then we've got a set number of pips, which could be, well, anyway, you could say I want a 10 pip stop or a 20 pip stop or 50 pip stop, depends what time frame it is that you're using. Then you can look at the nearest swing, which I've marked up as here. And then you can look at the major swing, which I've put as here. So there are your 4 variations of where you're going to be placing your stop losses. So let's just have a look at how it affects your risk reward ratio on each of these various elements. And then what we'll do is we'll look on a real chart and we'll see how it compares. So first of all, we've got a very standard take profit, which is up here. It's 1.415 just for the purpose of this video. And our entry for the first one, which is a pending order on the line, which I'll explain now. So let's say, for example, that is not there. Okay, so we're going to set our target up there. Price has come along, and this is a strong bullish candle. It looks as though the next candle is likely to break. What you could do, this is what I did going back 3.5 years ago. I used to place a pending order just waiting for the breakout, because quite often I would see the charts just shoot off without me and I wouldn't be involved. I wouldn't know where to get involved at that stage. So I used to set a pending order on the break line. The drawback with that is I think that the institutions tend to know that's where your orders are going to be resting. So quite often you'll see more than 2, 3, 4, sometimes 5 or 6 spikes up to there and then reversals. So in the instance that if you couldn't see anything going on here and you had the first bounce, the second bounce, and then you think, right, okay, the third time it's got to go through, hey, more often than not, it would actually just bounce straight back. You'd be straight in negative or you'd be stopped out really quickly. And it was so frustrating because it would happen over and over. So the first one which we've got is on the line. The second one which we had was the market entry on the close of the break. So bringing this back, the entry would be there. And then the third one, again, is the bounce back, so the pullback. So price would have to break through, not just a wick breaking through this area and then bouncing back, but where price will close above this line. That's where I would class a breakout. Otherwise, I would call it a faded breakout or a reversal or a fake out. Okay, so we're looking at price to break out and stay out and come back. And then the third one, essentially getting involved all the way down here. Okay, so let's look at it with a few numbers. Now, I've created a spreadsheet, a really, really simple spreadsheet, and I've worked out very basic risk reward ratios. Okay, so pending order on the line is the first one, the market entry on the close of the break, the pullback, and the pullback to the wick of the nearest opposite candle before the break. I know that sounds a bit of a mouthful, but it's worth looking at. So with the first one, the risk reward ratio, let's just make sure that this is correct. And this is what I urge all of you guys to do. So go back, have a look at creating yourself a spreadsheet, work on this sort of thing where it's a case where you can put in the figures, see where the risk reward is best for you, and then back test it at least 100 times so you've got a little bit more of an average range to go by. Because once you see it happening over and over and over, and you know that if you've got a positive expectancy, you can take that trade with a lot more confidence. And the confidence is key when you're looking to trade this live. Okay, so what have we got the first time? So pending order on the line, which is here, which is going to be the same as the pullback to the support resistance area. So what we'll do is we'll fill out these here. So first of all, let's look at setting our stop loss. Okay, so the base of the body break candle, which is this one. Our stop loss, let's call it 80 pips. Basically, it's a 2.53 return, okay? So you're risking 1 to make 2.53 back, that's good. A set number of pips, let's call it 70. So if we go here, change this. How's that changed our risk reward ratio? Where it's changed it to 2.86. So what you might find is that adjusting the amount of pips which you allow it to have, so it could just be a very, very simple set order. I'm going to set it to 20 pips, I'm going to set it to 10 pips, I'm going to set it to 200 pips. It depends largely on the time frame, depends largely on your risk or your mentality towards risk. Now, in this case, just for this scenario, I've set it at 70 and the target is 200 pips away. Okay, just so that's nice and clear. And then what we have as our next possibility is the nearest swing, which happens to be this line here. Makes our risk reward ratio at 1.82. And then at the major swing, makes our risk reward ratio 1.18. So looking at all these different scenarios of if we take the trade on the break of the support resistance line, it looks as though a set number of pips of 70 would be our best risk reward ratio. Otherwise, it would be the base of the candle before it, and then so on and so forth, so you can see. So let's look at a market entry on the close of the break. Okay, so how does that adjust and how does that affect our risk reward ratio? So we're going to move our entry to up here. Okay, so working backwards because it's a bit easier. The major swing is 0.68. The nearest swing is 0.94. The base body break candle is 1.16. The set number of pips being 70 makes it 2.14. And the base of the break candle makes it 1.16. Okay, so if you want to get in on the market break or the close of the breaking candle, it looks as though your best risk reward ratio is putting a set number of pips. So very much like setting a pending order on the line. Now, because we know the pullback to the support resistance area is the same as setting it as a pending order on the line, the only difference is the amount of times that it would actually get triggered. Okay, so on this instance, we're literally just going to copy and paste this. But now we're going to look at the pullback to the wick of the nearest opposite candle before the break. Okay, so we're moving where we get involved in the trade. So what we're looking for is for price to work its way back down to here. So it's to move quite deep in before shooting off towards the take profit target. Okay, so let's get this up. So the base of the candle which broke, which is right here. And here comes the big difference maker, okay? 8.51%. A set number of pips. So let's type in 70, which is 700 ticks. 3.57%. Or R, if you want to just do it based on risk reward. The nearest swing, which is here, which is 4.18. And then there's the major swing, and the major swing is 2.09. So as you can see, of all the methods to trade the breakout, there is one clear winner in terms of risk reward, okay? And it's this one. The one where price comes all the way back to the wick of the nearest reverse color. So in this case, because we're buying and the breakout is going north, we're looking for the nearest red candle and the wick to do above. So we're looking for it to go quite deep before taking off towards our take profit target. Now, this again varies on the type of strategy which you have. So when I'm trading, I don't necessarily set targets anymore. I know it sounds a little bit strange, but as you'll see on a few of my videos in the near future to come, there is no point in setting target. Why would you want to take yourself out of the market? Why don't you just allow the market to take you out when it's ready? Okay, you should be trading your stops up and scaling in as much as you can to extract the most out of the market absolutely possible. So that's essentially the 4 different ways which I know how to trade the breakout and also where to set your stop losses. But what I would be doing if I were you is go back, backtest every one of these different methods, do it at least 100 times on some real charts using the bar replay tool on TradingView and figure it out for yourself. Literally just do column after column after column on the spreadsheet and you will see which one is the clear winner. So what you don't want to see, well, it depends actually. It depends on your personality type. If you don't mind being stopped out on a regular basis, you might want to do it on a set pip stop. So let's say you're using the hour candles, you might want to do it on like a 10 pip stop, but that might mean that you're stopped out on average 5 times in a row, but you'll get a 10 to 1 winner. when you do win. And you could get maybe 2 or 3 of those in a row, but you'll still be stopped out 5 times on average in a row. Personally, I would find that a little bit difficult to do. My patience doesn't work well like that. I want to be winning fairly regularly, and it doesn't matter to me whether or not the risk reward ratio is super high or relatively low. As long as it's a positive expectancy, I just want to see green on my chart rather than red. But it depends entirely on you as a trader. So what we'll do next is we'll jump into the chart so we can see a demonstration as to whereabouts you could be looking to get involved. And what I'm going to do is I'm going to show a bit of a preview to my 1 minute London breakout candle trading, which I tend to do these days. And I would show you whereabouts I would look to get into the charts, where I would set my stop loss, and where the target just goes off to. Okay, so we'll jump over to that now. So here we are on the actual charts. Just so you know, this is on a bar by bar replay. This is a breakout back on the 30th of December. But what I'm going to do just for demonstration purposes is part of my London breakout strategy. I'm just going to mark up on the charts where the breakout is going to be. So what I'm looking at is, in terms of our breakout strategies, which we were looking at a minute ago, I always look to enter on the clean break of a session. So in this case, what I want to see is price come up, not poke its head through and create a wick and then close back down, because what I'll do is I'll move this line, which is my breakout line, to the tip of that wick. So what I want to see is price go up and close outside of the area. So that's why I'll be looking to get involved. Okay, I'm also going to be placing my stops behind the nearest swing. Okay, so I find personally, just for my own trading, that's the area of the most resistance, and it's least likely to take me out the trade. So this is part of my London breakout strategy. I've changed it recently to the 1 minute. One of the previous videos, which I'll show up on the screen somewhere, was the 5 minute and the 15 minute. But I have adjusted this to the 1 minute, and I do have a bit of a surprise with that coming up, which is going to be quite exciting, and you'll definitely want to be getting, well, hopefully you'll be wanting to get involved. So let's get stuck in and just follow what the chart does. Okay, so what we've had is, if you were involved in, like, let's say for example, you were involved in the market with a pending order, and all what you were doing was looking to get involved on the break, and you had a short stop loss. We're just going to say you had a 3 pip stop loss or a 4 pip stop loss. You'd be out of this trade already, because it'd come up, trigger you in, and then off you go. Okay, so that's one of the reasons why I don't like placing it on the pending line anymore, like I used to. So what I'm doing now is I'm gonna move this to the tip of there, and what I want to see is price. Let's zoom in a little bit, make it a little bit easier for you. I want to see price break out of here and stay out of here. So just so you're aware, what's happened now is that price has worked its way down. So if you were definitely in that trade, you'd definitely be out, or most likely be out, unless you placed, I don't know, a lucky stop somewhere sort of down here. But what we've probably got is a bit of a swing. I can't remember this trade entirely by memory, but I think that this is likely to be a swing. And if price breaks out, our stop loss will be basically underneath here. So let me just get rid of those lines, and let's continue the journey. There we go, we got it. So what I tend to do is I get involved on a market order. So I've just got to be really fast with my trading. And as soon as I can see that it's broken out, and I'll get an alert to say that price is nearing it. So I'll set an alert on my charts to say, right, price is coming up and approaching it. You want to be sat at your screen because you just need to press buy or sell. Okay, so I would be in the market exactly on this break. I know it's only maybe half a pip or so, but I would be involved here. And I set my stops below the nearest swing low, which is, it's there. So my stop in this instance would be 8.3 pips. Okay, so I would be triggered in here. If, like, by all means, you know, price can quite often come back down and take off, or it could come back down even further. So price could come back down even further. It could come down to the tip of this red one. Well, it won't go backwards, but it will certainly take off in that direction. So the other trade setup, which I really do like, and something which I'm trying to back test, I want to try and gather more data before I show this off to everybody. But basically, if price comes down to the wick of that red candle and then takes off, amazing. You're instead of it being, let's say for example that our target is just 10 pips away, so there's a target of 10 pips. We've got a ratio at the moment of 1 to 2, 1.2, sorry. If price was to come down to here, our stop loss stays the same, and bear in mind it was 1.2 risk reward. Now it's 4.55. Do you see the major difference with that? The only drawback is that it doesn't happen very often, and when it does, or when price does come back down to there, it quite often catches you out. So you need to have a bit of a thick stomach to be able to do it. But anyway, I will be getting involved in the trade right here, and let's just see where price goes. Continues up and takes you out. Happy days. Now, I'm not going to show the whole of the London breakout trading strategy because that's a longer video which I'm going to be doing in the near future, where the definition should be pretty good and very clear for you to be able to see. And that is a video that you definitely don't want to miss. And something else as well, which I wanted you guys to know, is that I'm going to be running a competition in the very near future where I'm going to sit down and I'm going to teach a complete newbie how to trade profitably within 5 days. So it's going to be 5 2-hour sessions on Zoom. We're going to record it. We're going to put it on YouTube. We're going to put it on Instagram. And I'm going to make this individual a profitable trader after 5 days. So if you want to take part in that, look at the show notes down below. And I'll look forward to hopefully seeing you on the other side of my Zoom screen, where I can positively and hopefully change your life for the better. So guys, thank you very much once again. I'm trying to take this channel a little bit more seriously, and I want to try and create a lot more videos in 2021 based on your suggestions below. I know previously that I've gone through the London breakout session a lot more than most traders. I'm also working on a New York breakout session, and I'm also looking at an Asian breakout session using a completely different currency pair. But if there's any other suggestions or ideas that you would like me to cover, I'm more than happy to go back through and back test. Even though I tend not to use them, I have got a lot of experience using indicators on the chart. So if you want to see indicators being explained properly in an easier to digest way, or in a practical setting like in the market, leave me a comment. Thanks guys.